The Great Britain occupied the Hong Kong in 1841 and established the Hong Kong as a free trade port. With the attraction of free trade port, most businessmen started to invest in Hong Kong. Before Japan occupied Hong Kong in December 1941, Hong Kong had become a carrying trade port and developing rapidly. Japan occupied Hong Kong for 3 years and 8 months, and Hong Kong almost stopped all the trade during this period. After the Second World War, most countries need a host of goods and materials to boost the development of country and economy. The level of goods demand became higher all over the world, so Hong Kong's external trade was reborn and the value of external trade reached to a peak level. During the war to resist U.S. aggression and aid Korea in 1951, Western countries led by the U.S. implemented embargo and blockade in the mainland of China, and Hong Kong's carrying trade has hit severely by this war. Following the reforms and the opening of China in 1980, the economy between China and Hong Kong developed rapidly. Hong Kong reunified with China in 1997, but Hong Kong reserved its own trade policies, for instance, no barriers to entry and no trade tax. At the end of 1818, Sir Stamford Raffles as a trading post of the East Indian Company with permission from Joe, and Sir Stamford Raffles started to establish a new trade port at the south part of Kara Peninsula. The Britain obtained sovereignty over the island in 1824, and Singapore became one of the British Straits settlements in 1826. Singapore occupied by Japan during the Second World War, and Singapore became a former colony of the United Kingdom on 1st April 1867. After that, both the economy and the free trade port developed rapidly, and Singapore earned recognition as one of the 4 Asia Tigers. At the beginning of 20th century, Singapore became the 7th largest trade port of the world.
In the part of trade theory, the main theory that will be used in our presentation is regional trade agreements. Regional trade agreements have become increasingly popular since the early 1990s. It means making free trade among a number of nations in a specific area or region. Free trade agreements belongs to regional trade agreements. It has proved to be one of the best ways to open up foreign markets to Hong Kong and Singapore exporters. Trade agreements reduce barriers to Hong Kong and Singapore exporters, and protect their interests and enhance the rule of law in the FTA partner country. The reduction of trade barriers and creation of a more stable and transparent trading and investment environment make it easier and cheap for Hong Kong and Singapore companies to export their products and services to trading partner markets. In 2011, Hong Kong signed free trade agreement with European Free Trade Association. It covers trade in goods, service, investment, intellectual property rights, government procurement, competition and trade and environment. Singapore also signed FTA with EFTA in 2002 and signed FTA with EU in 2012. It is the first bilateral free trade agreement concluded between the EU and an ASEAN country. Singapore has committed to remove all customs duties on goods of EU origin immediately upon the EU's FTA entering into force. Hong Kong and Singapore are free ports, but Hong Kong still collects customs on alcoholic drink, tobacco, hydrocarbon oil, and carbonyl. Singapore still collects customs on alcoholic drink, tobacco, sugar-related products, freezer, automobile, and industrial products. Both of EFTA and the EU signed FTA with Singapore, while Hong Kong just signed with EFTA, so the trade volume of Singapore in the European market is higher than Hong Kong.
Although from 1960s to 1980s, both Singapore and Hong Kong achieved significant economic gains, but they through very different approaches. Unlike Hong Kong, Singapore had to create capital from within. Singapore attracted foreign investment through heavy government intervention in the labor market, and the government tried to reduce unemployment to encourage trade. and they try to build a free tax pot to get revenue from this condition. However, Hong Kong developed its economy based on the GDP growth rate and without the government intervention. Until the 1930s, Hong Kong sold its products locally and in the south of China. But in the 1931, China increased its import duties, forcing the manufacturers in Hong Kong to seek new markets. The Trade Commission noted that apart from China, the natural markets for manufactured goods from Hong Kong were in nearby countries such as East Indies and the Philippines, but added the policy of national economic sufficiency adopted in those countries, resulting in high protected tariffs. Hong Kong benefited from cheap labor that made its products highly competitive in terms of price, and access to import markets would have given manufacturers their substantial boost. Since Hong Kong and Singapore owe their prosperity to a global system of trade built on comparative advantage, what role, if any, they would have in a world of restricted trade and import substitutions was very much an open question. The Hong Kong Commission feared that Hong Kong had to operate as a part of China, and their reporters suggested various ways that political and tariff barriers might be removed. Such a step clearly would have benefited Hong Kong traders. For Singapore, the condition was less clear. The British government was pressing for fuller integration with Malaya, and the Straits Settlement Trade Commission opposed the suggestion that Singapore join a Malayan customs union. Among other things, such a move would have made it difficult for merchants in Singapore to respond to the considerable trading opportunities in the Netherlands Indians.
According to World Bank statistics data, Hong Kong's total foreign trade volume reached near $1,200 billion in 2012, compared with $2.3 billion in 1960. It grew by 50,000%. Similarly, the rapid development of foreign trade in Singapore, the total trade volume of 1960 was $2.39 billion and increased to $1,040 billion in 2012. The growth rate achieved about 450%. Comparison of total trade between Hong Kong and Singapore. These two regions developed rapidly since the 1980s. Although the 2008 global financial crisis led to the decline in the volume of trade continued for 2 years. But in 2012, the total trade in both areas exceeded $1 trillion, still presents higher speed of growth. On the other hand, the trade performances in Malaysia and Thailand cannot catch up with Hong Kong and Singapore from recent 20 years. In these 2 decades, the data of total volume of Hong Kong and Singapore increased rapidly and was very much higher than Malaysia and Thailand.
Cool.
Overall, the trade performances of Hong Kong and Singapore are better than the other 2 countries. And the data of Hong Kong and Singapore is very similar. So, we will compare them with the other 2 figures, which are the FTD and FDI.
Foreign trade degree of dependency is often used to measure whether a region is export-oriented. The more dependent on foreign trade means the high level of the internationalization of the region, which could potentially lead to a high level of the trading activity with neighboring country. In order to calculate the FTD figure, we use the sum of the import volume and export volume divided by GDP.
These are the FTD figures of Hong Kong, Singapore, Malaysia, and Thailand. We can see that the FTD of Hong Kong and Singapore has always been above 100%. Malaysia's and Thailand's has been below 100%. Singapore's FTD is the highest amongst the 4. But remember, Singapore is not a very big country and they have limited source of land and natural resources. Hence, Singapore government must promote their foreign trade regulations and policies with a primary objective of promoting the basic needs of the citizens. Hong Kong's FTD figures has been increasing since 1980 and it is still growing. In 2012, Hong Kong's FTD reaches its highest at 450%, which makes Hong Kong one of the most dependent of foreign trade. Analysis forecasted that the FTD figures of Hong Kong and Singapore will continue to stay at the same high level, while FTD figures of Malaysia and Thailand will maintain at just below 100%.
On the other hand, Hong Kong and Singapore are two famous trading cities of free ports with almost no barriers of trade. Goods, service, and money capital flows through easily on a daily basis. The freedom of trade also leads to a high level of foreign direct investment, which helps to boost the economic growth of the region and promote the sustainable and stable funding. By promoting effective scaling factor and economic structure optimization, the long-term effect of the high level of the foreign direct investment will be an increase of the sustainability of the economic growth, efficiency, and the transfer of technology.
In the statistic of FDI inflows, it shows us from 1998, the FDI amount in Hong Kong was always greater than the other three countries. The reason is the Asian financial crisis in 1998 has seriously influenced the Southeast Asia countries. From 2003, Hong Kong's FDI grew rapidly and hit a peak at $96 billion in 2011. The FDI of Singapore plunged to the second lowest point in 2008, but it rises in the next few years. Malaysia's and Thailand's FDI inflows stay constant at low level, which means they are not the first choice for foreign investment. The FDI of Hong Kong and Singapore will still high in the future. The investment environment of both two regions will become more popular as well. In summarize, we provided our staff in trade history, theory, literature reviews, and the statistic comparison. The related trade figures of Hong Kong and Singapore have increased, but as we saw in the countries which not have the free port city, such as Malaysia and Thailand, the trade figures are in the low level. It seems the free port policy indeed can help the region become more stronger in trade area. Our group recommend that the developing countries can use the free port policy in order to increase its trade volume and its competitive power. Thanks a lot.